Good morning, everybody in the western part of the United States. Good afternoon to those of you on the East Coast, and welcome to our Tuesday livecast again. Today we have Markus Mollica with us again, the sales manager for TValue, and he's going to do some advanced training on TValue software. We've gotten great reviews on people that were on it last week. TValue is a very powerful software, very easy to use, and you're going to like what he does today. But before we get started in that, I just wanted to mention that we do have our boot camp in Boston, Boston on October 2nd to 4th coming up. 3 days of very intensive training, nothing to be sold unless we have some notes available to sell at the time, which we usually do. They have been in pretty high demand and our inventory goes rather quickly, but we're hoping to bring some so that we can go through just some examples, and then we probably will have some for sale. But it is an intensive training session of 3 days where we go through just about everything there is on both seller financed and institutional finance notes, about buying delinquent notes, about where to find them, how to raise money, everything you really need to know to be in the note business. And it is not a sales fest. We are not selling anything. We do not have a coaching program that we're trying to sell. You're gonna learn everything you need to know. The people that have attended in the past have been very, very pleased with the results. And there are testimonials on the website if you'd like to see it. So go to notemogul.com to find out more about it. And with that said, let's get started. So I'm here with Chrissy Jones, the president of our company. And we are very delighted to have with us today Markus Mollica with the TValue software. And Markus is going to take you through how to do partials, how to determine who gets what in the event of a payoff prior to the partial being fulfilled. What happens, who gets what amount of money during that period of time, and then do some step payments and so on. So Markus, thank you very much for being here, and it's all yours.
Very good. Yeah, thanks for everyone joining us today, and thanks again to Ron Hoppy for providing me with this opportunity to present again as our part two. And if you were with us last week, we're going to kind of continue on with similar type of thing we did there, and just make it a little more advanced, as Ron mentioned. Again, my name is Markus Mollica. Give you a little snapshot of myself. I've been here at TimeValue Software for a little over 7 years, and been pretty fortunate enough to work with many note investors over the last several years, and helping individuals with deal structuring and using TValue for their various calculation needs. Just always enjoyed working with the note investors. It's a very energizing environment, and just love being around it. Very often just a little training. Investors are off and running with really just the basics of understanding the program, and hopefully I'll be able to help you with that today. TValue is a flagship product here at TimeValue Software. Was originally created back in 1984, and we've been involved in the note industry since probably the late 80s or early 90s, and just have come to be a standard in the industry with TValue. Back in those days, the owner of TimeValue Software went out and gave some presentations on TValue and just how to deal structure a little bit, and I've been able to kind of continue that over the last few years. Some of you may know the names like Jimmy Napier. He was a big advocate of TValue, and even many of the seasoned investors today require that people that do business with them, or other investors that do business with them, are using TValue. So one thing I hear often from investors is that I'm just getting started and do not need TValue just yet. If you talk to a lot of these seasoned investors, people have been around for a while, just a good idea to get your head in the game and going through those different deal structuring types of scenarios so you get a better understanding of it. It's going to help you a lot more in your negotiations. So today, I'd like to show you some of those ways TValue can help you, and specifically with regard to partials. comes to creating deals, and it's in your best interest to make it a win-win deal. And I hope that I can help your creative mind today. And I understand that many people are new, so I apologize if I go through quickly. I'll do my best to keep it slow. But keep in mind, you can always give me a call or reach out to me with any questions. And I believe Ron is also going to have a recording of this as well. So these are some of the questions that I get often with regard to partials. What should I pay for a note or partial, especially when it gets into the partial side of it? Last week we did a basic intro on calculating a pay price or your investment amount on a note, a full note. So we're going to break that down into a partial and what you should do there, how you calculate your pay price. Also, how can I create a Schedule A to determine what payments are actually left on the note I'm purchasing? We went over this last week, and in TValue, as long as you know 3 of the 4 variables between an interest rate, the loan amount, the payment amount, and the number of cash flows or payments left, you can back into one of those 4 as long as you know the other 3. So then the other question is, how do I create an amortization schedule for my partial, which would be your Schedule B? And sometimes where I see the confusion there is many times individuals will keep their interest rate that they used for the yield of what they wanted on a pay price in their Schedule B. So I'm going to show you a little bit of the difference in that today and how to keep that clear and create a master schedule, which last but not least, what happens if the note pays off early? So you create a master schedule of Schedule A, B, and C, then in a perfect world, if that borrower pays all those payments on time every month, the spreadsheet's going to work for you. Otherwise, you can just update it with the present value calculation, if anything changes. So this is what I'm going to do. I'm going to go over those scenarios, do the Schedule A, B, and C, and calculating who gets what after 5 years into the note. So an example of going into Schedule A, this is kind of similar to what we did last week a little bit, so I just want to touch on this. And if you're given this information on the note, let's say the full note, does everything tie out? What is the context of this situation and this information that the seller has given me? Does it tie out and match in an amortization schedule? And again, I like to lay it out in this fashion. I think many people are familiar with this. So these are the variables I'm going to put in. I can solve for one of these 4 just to verify that everything is accurate. And what I'm going to do with that actual note is go through a couple scenarios on what should you pay for that. If I want a 15% return, how much should I pay? If I want a 12% return, how much would I pay for that? And you're going to see that it's going to be very easy in TValue to go through these scenarios. So let me go ahead and take you over to TValue now. And if you weren't with us last week, this is what TValue is going to look like when you open the program. It's going to show you what's called the cash flow data. This is where you enter all of your cash flows for your deal or your calculation, and then the amortization schedule tab, which is where all of your results are going to show up. You customize it, you can send it to Excel, which I'm going to show you what I do here in creating that master schedule. You can save these files. You can open them up at a later date and make any changes as need be if missed payments were missed or lump sums were paid down. So let me just go ahead and we'll just label this Schedule A for now. And as I tab or enter through the fields, it takes me sequentially through TValue, which keeps your dates in line and just make sure you're going in the right order. And keep in mind, any irregular dates that you have, you can apply. The loan date is on the 15th, the first payment's on the 1st. You can easily do that TValue. So let's just back into this note and make sure everything ties out. So let's say there's 9%, and let's say our balance on this note was $89,137.31. And we're going to just solve for, let's just solve for the payment here. And we're told that there are 180 payments left. So what we're going to do, once we enter that in, the number column here is my number of payments. And keep in mind, your loan and your payment cash flows are on separate lines. Sometimes I see individuals will put the number here for payments when it's on a loan event line. So once I have my unknown, then I can go ahead and calculate and get my payment of $904.09. Matches exactly to the information that I have. My amortization schedule is here, which I can save then as well. That way I have my Schedule A, or kind of what I'm looking at, what the whole whole note looks like at this point, or remainder of this note. And then you can go through various scenarios to see what you should pay and what you're going to do here. So let's say in this scenario, you wanted to determine what should I pay if I want a 15% return on my money. The key is keeping the cash flows in here. One thing to keep in mind is that whenever you do a present value calculation or your pay price or how much you should invest, it's always going to be on line 1. So if I want to solve for how much I should pay for 15% yield, first I'm going to put my 15% in the nominal annual rate field. I'm going to make my unknown the loan amount. And I calculate that, I get $64,596. So if I want a 15% return on my money, if I invest $64,000, I'm going to get that 15% return, given that I have these cash flows for 180 payments. If that pays off a little bit sooner, your yield's going to go up a little bit. What if I want a 12% yield? Very easy. All I do is just change the scenario. Now I could take 15%. I could then go to my file and save this as scenario 1, and then I can go here and put in 12, and then resolve for the loan amount or the pay price or investment amount. You can customize these event names to be what you want. So whatever terminology works for you. I go ahead and calculate at 12%. So I'm going to pay a little bit more for the note for a 12% return, get a little less return, so I have to invest a little bit more money, $75,330. So that's one scenario. Now, I was also asked a question here, what if we have step-up payments? We did a brief intro to doing step-up payments last week, and what does that mean? Basically, what if, say, for a period of time, let's say, or the payment amount, let's say in this scenario, was $250, and let's say they were going to make $250 for 60 payments. And then after that, now you'll see that from this end date, which is the 60th payment, this will go the next month, so 30 days later, it'll default there on the following line. And let's say that payment stepped up, so now it's at $450 for the next 120 months. The key is entering in what your cash flows are as these payment events. And again, as I said, doing the present value calculation, which you'll find is pretty easy to do in TValue once you enter in the appropriate cash flows, is to say, well, what's the yield that we want? Let's say 15%. How much should we pay? Unknown on line 1, which is a loan event, an investment, a pay price, all synonymous here. Okay, so we have our cash flows, we have the yield, and then we can go ahead and calculate and say, well, for $23,745, if I invest that, I'm going to get 15% return given these cash flows in the future. So we can lay out these different scenarios. Last week I went over one that was an interest only as well. And there's some little nuances in TValue that whenever you have interest only payments or rate changes, that, let's just say here, for example, I'll just show you a quick scenario that if we did an interest only in TValue, and if you were with us last week, see by right clicking on a payment line, it brings up what we call special series. If I hit the interest only tab and activate interest only, I'm going to get an amount that says interest only there. So we can just say, for whatever scenario it is, that you had interest only here, and then the payment changed. I'm just going to go over to the amortization schedule. Anytime you have this rounding amount, you can just select open balance for the time being, rather than allocate where that's going to go. But I just basically want to show you here that in interest only, you have this amount of $296, it's going to interest 0 to principal. So when I do a present value calculation, I have to make sure I turn this off, and I would go into normal, and then I would put in my $296 payment. I would put in my interest only payment. I forget the change there, but I would enter that in as a hard number. Check that number. 296.82. So let's just do this scenario real quick. I just want to show you how you want to make sure you normalize that payment. That way you have this here in order to do the present value calculation. It's very important. If there are rate changes in here, you want to delete those lines. So again, if you're in those scenarios and you have questions, you can give me a call. I can walk you through how to do those. So what now I want to do on that first scenario we just did here in calculating the 15% return and the 12% return, I think you're going to have a lot of options depending on what your needs are, what your investors' needs are. So let's take it back to the slides very quickly. In this scenario here, we did a 15% return and 12% return. One of your options may be to do a contract to sell where you would buy that at 15%, turn around and sell it at 12%, which would look something like this, as we just calculated. If you bought it at 15% for $64,000, you turn around and sell it to an investor who wants a 12% return, and you sell them the whole note, your fee or your profit is going to be the $10,733. So that's one option you can do there. Now what I want to do is kind of go into what the other options are and what we want to do today. And that's, I can buy the whole note and sell off a partial, or in this case, we're going to sell off half the payment amount, which in turn reduces my total investment, and even my yield is going to go up a little bit. So let's take a look at that, how that's going to look. And what we're going to do in that scenario is we calculate a payment of $904.09. Now, there's a little, that 9 cents is a little bit odd, so you kind of figure out what cash flow you're going to put in there. One will be slightly more than the other by small, negligible amount. But for the most part, what we're going to do is enter into TValue how this lays out with our 180 payments for the 12% return. Unknown is going to be what the investor would pay for half of those payments. So let's say $452.04. And the other half is going to be $452.05 if you're going to take it to the exact number, and I'm going to show you how that looks. So let's go back over to TValue here, and I'm just going to hit new, and what some may call this as the investor basis schedule. And this is essentially whenever you're doing a present value calculation on a pay price, this is going to be your investor basis. And this is one that I mentioned a little bit earlier, where sometimes confusion comes in between Schedule B and investor basis. So investor basis always has the yield that you're getting on when you're calculating your pay price. The Schedule B is always what the actual interest rate is on that note, so your piece of the pie, so to speak. So let's take a look at this one, which is we're calculating 12%. We're going to sell a partial to an investor. He wants a 12% return. We want to calculate what that investor should pay. And the amount is $452.04. Now, this is going to be obviously if on day one you do this, if I'm buying a note and right off the bat I'm turning around and selling a partial, the time value money could come into play. But if I bought this on 8/4 and then I didn't sell the partial until January 1, depending on when you're getting the money, when the cash flow starts, it's important to make sure those dates are accurate. So if you're calculating your return on your investment and you invested today, maybe you didn't get to hand sell the partial for a few months or whatnot down the road, you can easily account for that. So in this example, we have 180 payments, $452.04. We want to know what someone would pay for 12% yield. So for $37,664, an investor can buy half of the payment amount on that note throughout the whole term. Okay, so my initial investment was the $64,000, which bought the 904 payments, and I'm going to turn around and sell half of that payment amount for the whole term for $37,664.72. Okay, so let's now once I do this, then I need to create my Schedule B. So let's go back over to the slides. I just want to show you how this lays out, and then show you what we're going to do to create a Schedule B and a Schedule C. All right, so here's our scenario. We're going to sell the partial, so we buy 15%. Costs us $64,000 to buy the 904 payments for 180 payments. We turn around and sell a partial to an investor who wants a 12% yield. Okay, they're going to get half the payments calculation, my yield is going to go up on that scenario. It's going to go from 15% to 18.9 roughly. So now you can do that at TValue, where you would then just re-enter in the 26,000, solve for the interest rate with the cash flows in there, the 452.05, let's say, for me, the note holder at this point. So very easy to do. Now, the question always comes into play is, how do I create a Schedule B? This is, like I said, where I get some confusion. Schedule B is going to be that portion of the pie. So if I'm selling to this investor, the payment amounts of 452.04, and he's getting 180 of those, I want to create Schedule B at the 9% rate, at the note rate. So it's going to show what piece of the pie that he owns. What is that partial? What is that amount of the whole note that he owns? And this is how I'm going to lay that out in the TValue. So my interest rate is going to be the 9. I'm going to keep the terms. Here's my payment amount. I'm going to solve then for the present value, which is just going to show the present value of this portion of the note. Before I go into that, I want to just show you also, we would then create a Schedule C. Now, sometimes you're holding the note, you may not need to just create the Schedule C right off the bat. We create the master schedule, which will then show you Schedule A, Schedule B, and essentially Schedule C. So Schedule C, you can do at any time, whether it's at the beginning to see what portion of the pie is yours, or in the event of an early payoff, how much you should get. But I created this master schedule that'll simplify that in the event that the borrower is making those payments on time every month. So let's see here. And in Schedule C, it would pretty much look like this. And as you can see, we cut the payment in half, but it's just off negligible amount, 4 cents versus 5. So essentially the same amount, very close. And I would set that up the same in TValue. So then the question is, what happens if the note pays off in 5 years? So I want to show you Schedule Schedule B and Schedule C, how we lay that out, and then what that master schedule looks like. So first thing I want to do is go to TValue, show you how you're going to lay out Schedule B, which then you have your investor basis. So you might save that as the investor basis schedule. Then you have Schedule B. So let's say we rename this. If I do a file save as, keep everything separate, it's 9% is what the note, the borrower is paying on the note is 9%. And we want to solve for that portion of that partial and the value of that partial. So the 44,568 is going to be how much that Schedule B is actually worth at this point in time. And you can do the same thing with Schedule C, which would be pretty much the same thing, only this is 5 cents. So what I want to show you is what we do and what we can do in TValue is go to the amortization schedule, send this to Excel, and then put these into the same worksheet so that you can now see the visual of what it looks like at any point in time, that if this note pays off, whether it be a year or 5 years, we know who gets what. So here's an example of what this looks like. We've got Schedule A, which is essentially the whole note, what the borrower is paying, the note payer schedule. Okay, they're paying the 904. This is the balance of the whole note, or the remainder at this time. Schedule B is our 452.04. 452.04 for 180 payments. It's worth 44,568. And then if I scroll over here, my remainder interest, or me as the note holder, I bought the whole note, I'm selling out the partial, whatever the remainder is, which is essentially A minus B equals C, this is what I would get in the event of an early payoff at any given month. So if we scroll down here, year 5, say after our 60th payment, the borrower is going to pay the amount of $71,370, however it's getting paid off at this time, $71,370. The investor who bought the partial is getting the $35,684, and then as a very pretty much almost the same amount. Me as the note holder, I'm going going to get 35,685. So as you can see, once you lay this out, at any point in time, I just look at the balances and know what the borrower, the payer, needs to pay in order to pay the loan off, and then my Schedule B, which is going to be what the investor gets. Whoever bought that partial is going to receive, and I just get the difference. So it's as simple as A minus B equals C to make things simple and keep it clear. So, and basically when I put these in here, TValue is going to send them out in separate schedules. All I do is go and copy Schedule B, paste it right next to here, do a plus and minus of the balance columns, make that work. So sometimes you'll notice in TValue, if you have rate changes in here, that rate changes will take up a particular area. So the key when doing this is just to make sure each cash flow line, so let's say for payment 5, is lined up. And as you go down the schedule, you want to make sure all those payment lines line up. So once you do that, then you're good to go. Okay, so then what happens, let's just lay that out here. The note payer's balance is the $71,370. The note investor who bought the partial is going to get the $35,685, or $684, and then I'm essentially going to get practically the same amount. So it's going to lay that out really easy. I just want to show you another scenario because you have options here. In the event that you broker the deal and you sell it right out at a different interest rate, you buy the whole note, and you sell off half the payments, and it depends on what your plan is and what if you at different points in time, or where are you and what are your needs, and if you're trying to set up for a retirement plan, you might buy the tail end. So this is one scenario, and I just want to show you how this lays out real quick in TValue. Okay, so in this event, now what I want to show you here is that the investor wants a 12% yield. So we know that from this same scenario, the 64,000, let's go here, let's take a look at 904.09 was our payment amount. The interest rate, 9%. Sorry, I'm going to start back up here at the top. So we could take a look at what this note looked like at the beginning. Okay, and if I bought this at a 15% yield, as we calculated earlier, that payment amount that I would invest would, or the amount that I would invest would be $64,596. Now, let's say in this scenario that you sell a partial where it might be, let's say, the first number of payments, you have the same investor, maybe he wants a 12% return, trying to figure out how to make this a win-win situation. What are my needs? And if I'm trying to set up for maybe tail-end payments or my retirement, depending on where I am for myself and what I need, I'm going to sell him in a portion of that. And let's say I wanted some cash up front. And I'm going to back into this scenario here so that you can kind of see how it is. And the reason I do this, as I'm going to explain here, is I want to keep these payments even when I'm going to calculate how much the investor would pay. So say for a 12% return. So let's put our 12%. I'm going to solve unknown here. And before I did this, and I'll just kind of show you how I made this work, but I'm going to sell that investor 136 payments. And basically, when I calculate the present value, so he's going to get payments beginning 9/4 for 136 payments. Once a 12% return, well, he would pay $67,047. Remember, my portion, which I negotiated to the note seller, was $64,000. So essentially, what I'm trying to show here is that you can get a little cash up front and get the tail end. So the investor is going to invest $67,000 for 136 cash flows. kind of a nice scenario here. I have to give then to the seller $64,000. So let me take you over here real quick and just show you this so it kind of comes a little more clear. So I sell to the investor for 12%, pay $67,047. I then sell to give the $64,000 to the note holder, $64,596. So then a little cash up front of the $24.50, whether that be your fee or your commission. What about payments 137 through 180? Well, you get those, so you get the next 44 payments of 904, the tail end, and you can throw time value of money into this scenario, but the total of those 44 payments would be the $39,000, total profit of $42,000. So depending on what your needs are, depending on what you're trying to set up for yourself, is going to determine what scenario you're looking for. Also on the other end with the investor and what their needs are. So those are all the examples I have for today. And like I said, if you have any other questions or you want some help going through your scenarios, whatever that partial may be, you can get really creative and make it a win-win situation as much as possible. Just to throw out here, as I know a lot of individuals use Excel. We use Excel here at TimeValue Software just to kind of give you an idea of where TValue might be a little more effective. And I always hear that using the amortization schedules is a way to begin the negotiation, have that conversation and determine, what does the investor want, what do I want, and how do we make this a win-win situation. So basically we did on a broker, a note, buying at one yield, selling at another, looking at partials and how much you should pay for a partial. We did a step-up scenario that if the payment is $250 for a period of time, then steps up to $450, calculating how much you should pay for that for a particular yield. And then creating schedule A, B, and effectively creating a schedule C. And as I put here, it's easy as ABC, A minus B equals C.
Great, Marcus.
So, thanks for joining. I appreciate it. And are there any questions or anything that we would address at this point?
You answered all of my questions. I'm going to go play with it some more right now. So if we get any questions, we will either filter them through us to you or have them reach out to you directly. So appreciate your time.
Thank you.